Okay, thank you. Well, it's a great treat to be here. I'm not a slide person, and so I just want to tell you the slides for this, which are many, are available to you or will be by the end of my talk if you want them. So I don't know how many slides I'll even use. But let me just start out by first reminding us that the retirement funding problem is a global one. So while we've had a lot of discussion of U.S. and some mention outside the U.S., this is pervasive. Asia, Europe, even in Latin America, and certainly in the United States and UK. And if you want to look at where that problem comes from, there are many of them, but the first is, as we all know, demographics, the aging, and that we heard last night is not going away. It's going to continue for some time. The second one is the happy news that the populations pretty much around the world are living longer. And that's the good news. We shouldn't forget that. And the third one, which is a little more specific, is that if you look at the sources of retirement funding, it's government, employer plans, and personal family saving. Well, what's your bet on government benefits going up? Not very big. We can have a debate whether they'll go down, but okay. What about employer plans? Well, we don't have to do any surveys. They got out of DB precisely because the benefits that they had promised were too expensive. So they certainly didn't replace it with plans that are providing more benefits. So we know that went down. So what does that mean? Even to retain the historical benefits would require the third one to go up, personal saving family. And if we add in these other factors, it has to go up a lot. So that's where I want to focus on. I mean, if you take a particular benefit level, there are only really 4 ways to improve your chances of achieving it. Save more, which we put it that way. We could say reduce your standard of living. People don't like to hear those negative presentations. Work longer, or take more risk. Now, on the last one, which is always the one we choose if we can, because that's the future and we can have everything without having to do any cuts in anything, I would say that we as policies have to have the rule that if you choose that route, I don't mean individually, I mean as a policy, we have to state what is our policy solution should the risk be realized. I just have to remind you that the Nikkei in Japan 25 years ago was 39,000. It's under 20 now, 25 years later. Second or third largest economy in the world, still rich, politically stable, no revolutions. Think of what, do I think this will happen? No. Can it happen? Anyone that says it can't happen, it just did, I mean, so the reality is, you want to take more risk, fine, but then you have to have a policy of what you do in the events that it doesn't happen. The fourth one, and that's what I'm going to talk about in my last 14 minutes, is that you can improve the retirement benefits you get out of existing assets. So you don't save more, you don't get higher returns, you just use the assets more efficiently for the purpose at hand, which is providing retirement benefits. The two items instruments, things that can move the needle on this are annuities. Like it or not, if you annuitize, what you're basically doing is giving up money when you don't need it, when you've gone someplace better where you don't need benefits, okay, in return for more than when you're here. The other is the reverse mortgage. And in effect, that's somewhat the same thing. It says you extract that part of the value of the house that's not an annuity, the payment for your living, and you extract that value and use it to enhance your living while you're alive. And that's big and an important possibility. It's the most practical one for doing it because we're essentially changing personal saving for working and middle-class people, as anyone will try to say, is a onerous task. Now, we can, as was alluded to, just impose forced saving. The superannuation in Australia, Singapore sets rates. We could just say everybody has to contribute 9% to a DC plan. That's the law, okay? But absent that, convincing people to save things is a pretty tough task in scale. The advantage of the reverse mortgage is it doesn't require people to change their saving behavior. We know that for working middle class, almost all personal saving is the house. We saw the numbers Jim Paterba just put up. So it's huge in terms of the portfolio, and that's where it is. And so that's why the reverse mortgage, or some version of it, is critical, in my view, to how we're going to address the retirement problem. It isn't a matter of choice, okay? So that's the background I wanted to make sure we had out on this. And, you know, the other advantage is that, you know, I mentioned size. It doesn't require change in saving, and it exists. It's actually out there. Now, what I wanted to talk about is we heard, in fact, we just saw some data. This is the greatest thing since sliced bread, right, for retirees. Nobody's doing it. Okay, so there may be possible explanations for that, many, but I'm going to take the view that it has to do, at least for the longer term, I don't mean there's some with design. And I include in design the whole package. You can't just look at a piece. So, for example, you've got the best design, everything else, but if you don't change regulations to allow it to be done, it won't get done. So it's the whole 9 yards. I can't possibly do that in the 10 minutes and 58 seconds I have left. So I'm going to focus on one which is the component of providing the supply of funds for reverse mortgages. Korea was mentioned. Hong Kong is another, has reverse mortgages. Almost all of them are funded essentially either by government guarantees or by governments like HECMs. That's a problem. It's a problem competitively, but it's also, it's a problem because if this gets popular, it will blow up any government's balance sheet. Nobody's government's balance sheet is big enough if this became a cornerstone of retirement for almost everyone. When they get to retirement, they take their annuity, they draw down a reverse mortgage. Picture that over the next 20 years and ask what that would do to government balance sheets if it was all done by government. So like it or not, I'm talking about a private sector solution for lots of reasons. And so we have to talk about how you market it, fine, we have to do all that. I'm going to talk about where you get the funds. And I'm going to say one of the problems we have and why I think we have government doing it and government guaranteeing it is we violated Rule 000, first-year finance. When you took your first finance course, what did you learn? Put the risk with the best holder of the risk. That's going to get you the best terms and the most scalability. And I think we all agree, if reverse mortgage is going to be a cornerstone of retirement, we have to have a supply of funds 365 days a year in good times or bad. It can't be periodic, aperiodic. It has to be there all the time. So it has to be scalable and always there. That's the design criteria. Anything other than that is not a real design. So where do we go? We call them, first thing we ought to do in design is to get rid of the name. Reverse mortgage has a terrible reputation in many places. Secondly, it's misleading. We called it a mortgage, and while legally it may be, it bears very little characteristics of a mortgage of the traditional kind. And because we call it a mortgage, I think, oh, who should be providing the funding? The risk part of the funding, not cash. Oh, it must be banks or other credit institutions. That's what mortgages do. Wrong. For this design, the best design reverse mortgage from a user point of view, from an efficiency point of view, is going to be very, very risky in terms of default. The easiest way to see that is suppose that you had no beneficiaries. What would you do with a reverse mortgage? To get the most out, you would extract the maximum you could, because anything you leave on this planet is wasted economically from your perspective. I just want to use that extreme so you see. So a well-designed reverse mortgage should be risky at the time of origination, much, much riskier than subprime or the traditional mortgages. Well, that poses a big problem if you're going to use credit institutions to fund it. Because credit institutions think of default as, you know, on the verge of immorality. I mean, you know, they hate it. But who even hates it more are the regulators of credit institutions. They spend all their time making sure that the banks are safe, not that the consumer gets what they need. And that's their task, so I'm not faulting them for it. So how do we finance it? Okay, that's what I'll do with my last 7 minutes. What we do is we design a reverse mortgage, non-recourse, just as it is now, all the rest. And then you take it and you put them into pools, you know, so you take 100 reverse mortgage and put them in a pool. And then you tranche it. Nothing like 208, 207. Very simple. 2 tranches. You could have 3, but let's say 2. One's called super senior debt. How much of that? Well, these things are risky now, right? Only enough so that they really are bankruptcy remote. I don't care if you have 80% equity in these things. You understand? So the debt coming out of the tranche is not something that minimizes the equity of the tranche. It's something that is truly, essentially risk-free. Now, even I, as a teacher, could market that. Why? Because, as you know, it's, one, you don't pay anything till you leave. Most people will stay in that house till they go someplace better. So probably the duration of these mortgages are 13, 15 years, typically. What duration does a pension fund need? What duration does an insurance company need that has annuity to hedge those liabilities? About 13, 15 years for immediate annuity. So there's a natural buyer there. And by the way, note, unlike most people who buy mortgages, the retiree, you, don't care what the interest rate is on it. I mean, you care, you'd have it like that. You don't care because you're not paying it. When it gets paid, you're not there. So you see it as you never pay anything. What you care about is getting a very high loan-to-value ratio. Very different characteristics. So that means you, the person who's structuring this, can choose the interest rate, not at random, as a market. But you could choose, for example, to have it indexed to inflation. So they're not going to care. That means you can find a supply, a big, and if this is going on all the time, consistent supply of 13, 15-year duration, including inflation-protected bonds. I know I can sell those anywhere in the world, in Korea, in Hong Kong, United States, UK. Okay? So if I can even sell them, you know, that's a pretty easy. But what about the residual? The residual is all the housing risk, you know, the default risk, is in the equity. Who do I sell that to? That's usually called toxic waste. Well, first of all, I would go to sovereign wealth funds, pension funds, insurance companies. Maybe we'll figure it out for BlackRock, okay? But let's stick with those. Who do I go see? I don't see the people in the loan department. I don't see people in fixed income. I don't see people taking credit risk. I don't talk to any credit people. Who do I go to see? First of all, I go to the equity department, but I don't go, let's say, to the hedge fund, opportunistic, let's make 22% returns, take advantage of this. Something that is sensitive to rates of return. People's compensation, for example, is related to how high a rate of return they are on assets. I don't want to talk to them. They're going to give me high prices, and they're going to get out whenever the market conditions aren't good. And so they aren't reliable, and they're going to be very costly. Who do I go to? I go to the core equity manager. That's a euphemism for the manager who's responsible for the essentially indexed part of the portfolio, which every large institution that holds equities has, no matter how active. So every one of these institutions has core equity. How does that manager get compensated? By rate of return? No, they get market returns, whatever they are. They get compensated for providing diversification and for tracking. That's what they get paid for. So I sit down with that person, guy or gal, and say, how would you like to be core equity manager of the year? And I say to them, if I'm here in the US, I say, by the way, how much owner-occupied residential housing do you hold in your portfolio of your core? The answer is 0. Those mortgages have so little, even subprime have so little, so they have none. I say, what's the market cap of owner-occupied real estate in the United States? Well, they may not know exactly, but I think they'd figure out that it's bigger than the stock market. So I said, I see. So your job is diversification. Diversification, the first order is the market portfolio. And here's an asset class larger than the entire stock market, and you own none of it. How well diversified are you? You see how the conversation begins? The conversation is what rate return? No, I never mentioned a rate of return. The market will figure that out. I say to them, you need diversification. This is huge, big diversification. And that's the key. The key is you market it to the right person with the right set of principles to match the design application they need. When you do that, then, of course, and now I'm down to 2 minutes, okay? After I've done that, and I sell them on that. They're the equity buyers. How do they figure out the equity risk? That's a thing called delta. You know those put options you're selling? That's just exposure. It's exposure to owner-occupied real estate. Equity people understand that. It becomes an asset class. By the way, if it becomes a big asset class, which it is, then you'll have derivatives on it. You'll get all kinds of things. You'll have them sliced, diced by zip codes. I mean, you can do all of that. All right? It's a natural. But then when I finished with him, as I'm going down the door, I said, oh, I forgot to ask you, how much Korean owner-occupied residential real estate do you own? Of course, the story is the same. So I said, I've got some Korean stuff, and why don't you take some international diversification? And some Hong Kong, too. And when I go to Hong Kong, I tell the same story, and I point out that in Hong Kong, well, it's sunny a lot of the time. Sometimes it gets rainy. And in Hong Kong, if it's depending on local financing, they disappear. But global financing is the most stable you'll get, because it isn't raining everywhere in the world. These are indexers. They put the money in these asset classes whether times are good or bad. So to my view, and that's my last 40 seconds, I'm sure you can improve on this. I'm just trying to set a bar. The bar is that I've given you in a place where you can take this risk where they don't look at it as toxic and we've got to try to minimize it. That's what we do. Secondly, we never had a discussion of what a rate of return would be on that. We had a discussion that this is a natural asset class, it's big, and it's diversifying, and you could be manager of the year doing it. Third, it's going to be the most stable financing you'll find because it's indexed. They put the money in all the time. They don't exert that type of judgment that you see in a hedge fund or an active manager. So this is really critical to me. If you get the right supply, and if you get on a reliable basis, you'll get good product, you'll get good discipline, the options will be defined, and we'll have at least that part of the solution done. I would mention, you were talking about all the moral hazard and so forth. If we really decide this is a policy issue for working middle class to make it possible, then we just say, annuitize. Take your reverse mortgage and annuitize right away, maybe not all of it. Now you don't have any of that worry. And it works perfectly. For those of you, I should also point out that from a global manager point of view, it's lovely that it's non-recourse. You don't have any of the complications of local credit, you know, who's the owner, because it's an asset-backed. And if you want to look at the property that you've invested in, you're a Dutch pension fund investing in Des Moines, Iowa real estate, you take Google Street and you kind of look right at the building and see if they're cutting the lawn. You look on the internet and you pick up what the latest tax assessments are, which are an estimate of market value, and then you have all the other zip codes. And if this starts to roll, you're going to have a lot of market data generated by this. So what I want to close now and say is, stepping back, none of this is new. I used all existing, well-proven market practices with existing institutions. Yeah, the regulations, a bunch of stuff got to be fixed. But nothing here required something dramatically different than what we've been doing in size and scale. That may not be good for an academic career, but I think it's good for getting something done that has to be done in size and scale and getting it done before the end of this century. Because we can do this now. And there's no reason we can't. And I think this is an important and exciting thing. So I'm over, right? No, you're good. Well, I hate to say you're not. Well, there's a red light blinking, which made me think that, yeah. But, you know, so anything else I wanted to say? I think I pretty much, you know, there's no reason why I can't end early. That would be a record for me. No, I think I've pretty much got it all. I said I think that you get the message. If you missed some of the lyrics, I hope you got the melody. That this can be handled. It's a complex problem, engineering problem. It's not a science problem. All the pieces are there to solve it. Do it in scale and make it a permanent solution with global diversification using the tools out. And finally, for those of you in asset management, I don't understand why you aren't all over supporting reverse mortgages. for your self-interest as well as society. They're going to generate money. They're going to release those assets that are sitting there in the house, and those assets are going to have to be looked after. So maybe this is a case where you can do well by doing good. Anyway, that is an advertisement. Thank you very much.